Good afternoon, everybody. Welcome to our selecting an option strategy. I'm Connie Hill. I'm happy you joined me here today. You know, in the markets that we've had recently, there's a lot of different strategies we could explore. Last week we had a survey, and you guys were so good at responding to the survey. I appreciate you doing that. And many of you said, hey, these are some things we're interested in. I'm going to try to hit on 3 of those today. We have a lot more than 3 to get to, but at least 3 today, including management of flag patterns, management of long synthetics, and the possibility of talking about a change of polarity. If you don't know what a change of polarity is, you will find out here as we get going. Now I am joined in the chat by Barb Armstrong. I'm so glad Barb's here. She's a fantastic coach and a good friend. She's going to try to help answer some of the questions maybe that I can't get to, but let us know what your questions are. We want to answer them. If you're listening to this on the recording, and I know there are lots of you who do, when you have a question, go ahead and type it in the comment section. I'll go back to those. I review them throughout the week and get your questions answered as well. Now, I hope you're following us on X. I'm Connie Hill, CS. Barb is Barb Armstrong, CS. We'll post educational content throughout the day, things with charts, things we notice, maybe some tips and hints about particular things. So feel free to follow along. It's free. It's easy. All right. Let's go through our disclosures, and then we'll get into our agenda here today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for informational and educational purposes. Don't consider it a recommendation. We will be using a lot of technical analysis here today, but you should not use that as your sole means of research. We will be using the Paper Money software. Okay, that's what you download to your computer. It's the most robust version of Thinkorswim. Investing involves risk, including the risk of loss. Spread trading must be done in a margin account. Past performance of any security or strategy does not guarantee future results or success. When we talk about short options, there is a little bit of difference in the Paper Money and how a live account works. In a live account, you can be assigned at any time up to 2 before the option expires. So that means you could possibly have an early assignment. Paper Money doesn't do that. So we don't want you to have a false sense of security that never happens. All right. When there's always a possibility from the moment you sell an option. All right. I hope you guys are planning to come to one of these. And if not one of these, then one early the next year. All right. We've got Miami coming this weekend, a market drive event. We've got Orlando in 2 weeks, the 6th and 7th. That'll be a workshop with technical analysis and option strategies. And then on the very next weekend in Houston, same thing, options and technical analysis. They're free. We're nice to you. We feed you. All right. So take advantage of those opportunities. If it's convenient for you to get there, take advantage of it. Now, as far as our agenda goes, typically we want to review market conditions. Why is that a big deal? Well, that kind of gives us a lens to look at the market that we might say, okay, this type of a strategy might be more beneficial than X type of strategy. We're going to look at a lot of examples here today. So let's first go out and take a look at market conditions. We're going to hop out to our Thinkorswim. And I'm just going to start us up here in SPX. And I have several moving averages on the screen, and I have a market forecast study here in the chart, this lower study. Some of you may be familiar with this, some of you might not. I talked a little bit about it last week in one of our classes, and it's a study that you can have access to, okay? I'm going to show you on the studies where it comes from and what it means. The one that I have that we're looking at here is called Market Forecast, and then I have a KR after it. In yours, you're not going to have a KR. Yours is just going to say Market Forecast. All right, I'm going to show you the difference. I'll add it on the screen here as well. Maybe I don't want it exactly there. Let's maybe go, this needs its own, this needs its own. All right, that's better. This one that says KR at the end is a ThinkScript. Many of you are familiar with ThinkScripts. We share them. When we do, remember, they're not guaranteed as to accuracy or timing. Let me show you what this looks like, and I will share the enhanced version with you. The market forecast tool gives us an idea of what is going on in certain time frames. Okay, this green line, and I'm going to refer more to the bottom area here. This green line gives us an idea of what the intermediate trend of the market is doing. You can see it doesn't wiggle around a whole lot. Okay, it can take a few weeks to go from the what's called the upper reversal zone, which is 80 or higher, to the lower reversal zone that's in that green shade, that's 20 or lower. It can take a few days to do that, maybe even a few weeks. All right. The other two lines are green and, are blue and are red. Our blue is called a near-term line. The red is a momentum line. Momentum is really short-term. It can go from the upper zone to the lower zone or vice versa in a day or two. So really short-term traders might pay attention to that line. And the blue line, the near term, is more of, you might, if you're a swing trader, right? It's looking at maybe short periods of time, maybe like 3 to maybe 8 or 9 days, maybe up to 10 days, and giving us an idea of where the momentum seems to be at that point. Okay. So that's why I say if you're a certain type of trader, primarily you might focus on maybe just one of these lines. Now, the regular market forecast, it has those lines and readings as well. This enhanced one that I'm going to share with you, let me go to I'm going to go ahead and paste this over to you for my scratch pad. You really just need the URL, and really on the URL, you just need this little bit that comes after the slash. Okay, that's all that you need in there. And it'll give you the enhancements, right? So we can see the actual reading of each of these lines. For example, the intermediate line is at 64 and it's falling. When we see something come out of the upper reversal zone like this green line, once it comes out, then we become a little bit more bearish, a little bit more defensive. And then maybe when the green line gets below 50, we might feel like, okay, it's time maybe for some more bearish strategies. If you had some, say, bullish strategies that were shorter term in nature, you might be wrapping them up if they didn't get you out when you became a little bit more defensive. Okay, so we're going to use that in the context of what are we seeing for our market forecast here. I'm going to get rid of the original one. Go ahead and hit apply. Those of you that are on the recording for this script, what you'll want to do is pause the recording, go ahead and write it down, and then I'll also post it in the notes after we're finished here today in our post-production work. I'll go ahead and put a copy of it in there as well so that you have that link. Now, overall, the SPX has been more so on the bullish side, hasn't it? A 10-period moving average is this blue line, and it's a little bit below it right now, but it's sitting right there at the 30. That's the red line. It hasn't pulled back as low as the 50, which is more of an intermediate moving average. So overall, we might say, gee, it just made a higher high when? The 11th. Okay, so just last week, made a higher high. And so, yeah, overall, it's still upward trending despite what, maybe the last, let's see, I'm counting 6 out of 8 days have been more bearish or sideways versus, after this little peak and run up. Joe says the market forecast looks like a spider on LSD. You're probably talking about the jaggedness of it and up and down. Yeah. Let me just see. Oh, Rams, I'm happy to see you are going to be in Houston. I'm catching up on my chats here. Fantastic. Let's look real quickly at the NDX. Very similar type things happening here. Has it come out of the upper reversal zone? Yeah, it has. And the particular reading right now is 57 and it's falling. So we might be a little bit more defensive at this point, looking at that green intermediate line. And actually a little commentary here on the other moving averages, or the other lines here, because they're not technically moving averages. But our swing time frame, the blue line is flat, so it could indicate a pause in the short term, in that kind of swing time period of time. It could go either direction at this point since it's been flat for a couple of days. But our intermediate, or our very, very short momentum line, that red line, it's headed down. That would give us the idea that maybe for the next day, maybe the next second day, it could be a little bit more bearish in the market. But as soon as, say, if this red line goes underneath and as soon as it comes out of that lower reversal zone, then the very short term, that momentum can go very short term number of days. Like I said, it can go from either zone in 1 or 2 days. So whatever the direction is, that is if you'd consider yourself bearish or bullish in that time frame. All right, if you have some questions, go ahead, let us know about them. So in terms of our posture, let's look what one last thing is going to be the VIX. The question is going to come up, can you use the market forecast in with stocks as well? And you can, okay, if you would like to. Some people do, but you don't have to, okay? But it's helpful to know what these different lines mean. All right, volatility, well, it's up a little bit today, right? Looks like maybe it is at 1831 right now, which isn't super high, okay? When it's been higher, say in the last few months, it's been up around maybe 23, but that's not really that high. We get into our 30s and 40s and higher, that's when volatility is incredibly high. And we had this one day, right, that spiked earlier. International markets were involved there, and maybe some changes in the carry trade that were going on internationally. And so it really spiked some volatility, but it came back pretty quickly. Now, if we're seeing this right now, seeing volatility maybe peak a little and seeing that the markets maybe pull back a little bit, the question might be, well, what should our posture be? Are you more bullish, bearish? Are you more neutral? And it might depend on the time frame that we're talking about. Let's go back to the different strategies we talk about here in this class, because you may have a different outlook than your neighbor, okay? When the markets are overall bullish, we know that intermediate trade is up, but if somebody's really focusing on the shorter term trades and it's been a little bit more bearish or becoming bearish, then, you know, they really might focus on some of these strategies. But overall, in our class, when we're talking about things, we're going to be looking at that intermediate time frame. And I would say we're still overall bullish, okay? That we're not really looking at many bearish strategies. However, to answer one of our questions today, we are going to maybe look at something here not totally neutral, like a calendar or say a double diagonal or something like that. But we will kind of be focusing on different strategies off this list over here under the bullish strategies. Okay. Oh, let me see what Christopher's saying here. Are institutions going to settle with a 17% increase and trying to make 2025 a fiscally flat year? Who knows, right? Yeah, we don't know. And there's always going to be opinions out there. There's always going to be people throwing out their ideas, right? And so that makes our job, you know, helpful or not helpful, but it might give us some insight, but it can be kind of confusing as well, which is why I'm a big proponent of saying trade what you see. Okay, trade whatever is going on in the charts that makes sense to you. Now, one of the requests that we had from the survey last week was talking about management of long synthetics. Okay, and can we talk a little bit more about that? Because a few weeks ago, we had it like 2 or 3 weeks in a row, we talked about long synthetics. In fact, last week, we followed up on some because we had some trades, we had some synthetics going, and then so a couple of them just really exploded with really big results. But I do want to kind of touch back on this. We are going to put on another synthetic trade. We'll talk about the management of that trade in a little bit more detail. But the one thing that you might have in mind is watch the chart very closely, 2-3 times a day maybe, because you might find that early in the morning the market's one way and then it's changed drastically, might be giving you an exit the next day. We had tremendous returns, which I told you is not normal and probably you wouldn't necessarily expect. We had a big move in our Tesla trade simply because of the results of the election. All right, and Tesla had a really big move up here and it continued to run after that. And more than anything, it wasn't any special Tesla news, but maybe federal attention to different policies. Maybe those might change that might be more favorable to Tesla. And so there were, the day right after the election, I looked at it. I was like, maybe we should take some profits. These are looking pretty good. But there was a lot of volume that moved in that day. So we said, okay, let's hold on a little bit longer. And we're going to get out on the first sign of weakness, or something else you may consider is just getting out of part of the trade. Okay, if you have multiple contracts, you might consider that, right? Say you had 5 contracts, you might say, ooh, maybe in one of the first couple of days where you're really feeling happy about the returns, maybe you take off some of the contracts, okay? But you're always going to want to watch it very, very closely. All right. Let's take a look at the following chart. I'm going to get off. We're going to take the market forecast off because I don't want to look at it necessarily, and with some of the individual stocks that we're going to be looking at here. First stock up that we're going to take a look at is EQT. Now, this stock has been really on a tear. This is one that came from the early morning mover scan that I share with you and I post about in my Twitter or my X account. And I'll show you some of the stocks making some big moves. Sometimes I'll focus on different industry groups. I think this was an energy stock, and some of the energy stocks, man, they came out of the gates really quick this morning with some decent moves. And on this particular stock, you can see, let's maybe even just go a few weeks ago. This is back in August. It was down at 30 bucks. Hit today at $46. So it's really having some interesting and good momentum. And so you see something like this and you're like, man, this is the 50-day moving average. It's clear down here, the 30s down here, man, and maybe it's even quite a bit above the 10. And so it might be a little concerning to you going, oh, I don't know if I feel like I'm chasing it, but what I am seeing here is kind of a short-term breakout. And when I went to a longer range chart, when I pulled up a 3-year chart, and I said, well, where is kind of the resistance in this area? Where are the peaks hitting here? They're really pretty close to where that short term was. But I said, hey, maybe it's just broken through some short-term weakness. So when you see a breakthrough of maybe multiple time frames, can give you the idea, especially if there's some extra volume, that there's some momentum behind the move. Right? If it's gone through multiple time frames and that volume comes in, it lets us know institutions and others are enjoying the move as well. Okay, so we've got some extra volume here today. So that lends more credence to a breakout. All right. For this particular trade, because somebody said, I want to do some more detailed, have some more detailed information on managing a synthetic, we're going to put on another synthetic on a stock that's very bullish. Trying to see if it's still sitting here. Yeah. We look at EQT, and this watch list is the early morning movers bullish one. This week it's up 7%. Over the last month, it's up 27%. Last 3 months, it's up 37%. So it's not guaranteed to continue to do that. But when we see stocks that have some really good momentum, then you might consider doing more aggressive strategies. Now, you don't have to. And the reason we're doing this particular one is because somebody really wants to drill into that. So what we're going to do, we're just going to put on a new trade, and we are looking at the stock about 46 bucks. So we're going to do this. We're going to buy the long call, and then we're going to sell the put. 2 bullish moves. That means we're really going to have to watch for first signs of weakness creeping in. All right, because then we'll want to shut down the trade. We're not planning on it taking us very long. We're not planning to be in here a long time. Some people might be in for just a few short days. Okay. We might be in by the time we get together next week. I'm hoping that we are, but if we have an exit signal, because I'm going to watch it, I'll go ahead and get us out of the trade. But I would like it so that we can do some more monitoring of it in class. All right. So let's go 46 long call, 46 short put, a combo. You're going to notice because we're selling that put, it takes our net debit clear down here. Okay. Keep in mind, if puts go against us, a short put, or say it goes against us, we might have to buy it back at a fairly large price. And on the long call, it could move the opposite direction as well. So that's why we're watching it very, very close. Okay, so that's going to be our first order. We're not going to put in an exit, but if you wanted to, you could. If you said, I don't want this thing going lower than today's low, you could put a stop in there and say, if it were to do something like that, I think it's reasonable, okay? But it could come back and kind of hang out here tomorrow and the next day, right? It could stay kind of in that region and not really be a violation of the trend, okay? So we're not going to put it on yet, but as we manage the trade, you could consider that and putting on a stop one night, changing it the next night, changing it the next night, assuming the stock moves up for us and acts favorably. You can always at any time also say, I am thrilled with the results I'm getting out, or these results are not going well, get me out. Okay, so we're going to go ahead, we're going to put that in, we're going to follow up on it. Wrong tab. All right, confirm and send. This is going to go to our option strategies bucket. There we go. Now, another request that came in was to say, you know, a long time ago, well, they didn't say a long time ago. They said a few weeks back, could have been months even, a class was taught on what's called a change of polarity. And somebody was interested in maybe having some follow-up on that idea. What is change of polarity? Change of polarity is maybe when you do something like, say, a short vertical, which is the trade we're going to do. If it kind of goes against you and you think, man, my initial analysis, based on what I did there and based on what the stock is doing right now, man, I think it's changed, and you might reverse the trade. Not just get out of it, but go the opposite direction. So if you're bullish and you think, man, things have changed, you might change it and go bearish, and we will maybe buy back a short leg or sell a long leg, depending on the situation. Okay, so let's take a look at this stock. This stock, Applied Optoelectron, it's been moving really well as well. I think it came back in our early morning movers somewhere. This is really extreme performance, okay? 93% in the last month, 238 in the last 3 months. And a lot of it you can see has just been in the last couple of weeks. Okay, now I haven't really looked at this stock this much. I've just noted it coming up on our early morning movers quite a bit. But it had a tremendous move when they announced earnings here. And you can see I've drawn in what? A flagpole. Let me just kind of remove that piece of the drawing. So our sharp vertical move up was only 3 days. Then it's kind of been going sideways. And what's it doing today? Breaking out of that pattern. So the expectation on a flag pattern is that the stock, we're looking for it to move as much as it did as far as this flagpole goes. Okay, we're thinking another sharp vertical move up. Now, some of you might go, ooh, it's up over 14% right now. Ooh, I don't know if I feel comfortable with that. That is a lot of volatility. In fact, we go over to the trade tab for just a moment. We can look at its beta. Beta is a measure of volatility. A beta of 1 means it's equal to an S&P 500 stock on average. Something that's higher than 1 means that it's more volatile. And so this being a 1.8 means it's like 80% more volatile than the average stock on the S&P 500. If it was a 1.2, then maybe it's only 20% more volatile, okay? So we can see, yeah, this one is a really volatile stock. And yeah, even though maybe the stock's up 15%, is this kind of normal for this stock? Well, more recently, if we're looking at averages, yeah, it has a tendency to move. Now, some people might say, I'm going to wait and see if it pulls back tomorrow and maybe get a little bit of a nicer entry. We know the midpoint of a candle many times will be a support for a stock. So maybe if it pulls back, maybe it only kind of goes midway down this candle. But because we're not going to be together tomorrow, we can't look at it together, then we're going to go ahead and do it in our portfolio here today. So because we'd look for a real directional move here, we're going to do a long vertical, but we're also going to do a short vertical. Short vertical in case we're wrong in our analysis and we want to see a change of polarity. I don't know if it'll give us that opportunity, but we'll see. Now, when we're looking at verticals, many traders like to use that 20 to 40 day time frame. Sometimes it goes out to 50, depending on what kind of options are available. So our December options kind of fit that bill, and I love the open interest. You guys know I look for open interest. If it doesn't have open interest, I'll have a tendency to just pass by the play because I want there to be a lot of liquidity in the options. I want to make it easy for us to get in and out. Okay. If it's only trading a few contracts, that's going to be trickier. And if you're somebody that likes to trade 10 contracts, 20 contracts at a time, you really want to look for that lots of open interest. Okay. So looking at it directionally, our first trade, we're going to do a 30-35 long call vertical here. Love seeing how much activity is here. So I said 30-35. We want the stock to move beyond 35. It's 32.76, so it's a decent ways that direction. Okay. 233 or 230 now is going to be our net debit. So kind of liked that 230. I'm gonna change it. We're gonna lock in that price so quits jumping around on us. Okay. And what we're gonna look at here, we've got the other thing I wanted to point out to you was how pricey these options are and the implied volatility priced into them. Okay. They had earnings, so they're out of kind of the window of earnings coming up, I believe. Let me make sure I'm not lying to you. Yeah, because that big move was over earnings. So that's going to be pretty pricey. Somebody might say, well, maybe I just want to buy the long option, and you might, but they're just really expensive. And that's where kind of using a long vertical can be helpful, is that it doesn't cost nearly as much to get into the trade. And then it buys you a little bit of time if the stock doesn't move as directional as quickly as you would like it to. Okay. That's when it is very helpful to be, say, in a long vertical. All right. So we're going to do this long vertical here. And we can do 3 contracts. And we're going to do a first trigger sequential. We're going to create an opposite order. And we're going to go buy it back when we get, magic number today is going to be 70%. You get to choose, okay, what that percent is. And I like to set it up when we go to get into the trade initially so that if it makes a quick move for us, then hopefully the trade will execute for us and exit us out of the trade. So if our net debit's 230, that's our max potential loss, that our max theoretical gain could be in the neighborhood of 270. So as we come to our calculator here, we're going to go to 270 times 0.7. That's going to give us a value of 189. We're going to add that on to the 230. So 189 plus 2.3 gives us a value of 419. So we're going to plug that in. We're going to say, all right, if you get to that point, go ahead, execute the trade for us. Again, we're going to watch this carefully because it is such a volatile stock. And this is directional. All right. So we're taking advantage of the long call vertical for the directional piece of it. And then we are going to do a short put vertical. Sometimes showing you how to change that polarity is easier on a credit spread than a debit spread. So that's why I want to do the second example. All right. Let's still go to our options bucket. And then let's put on the short vertical. Same thing here. We're looking at the same time frame. The 30 strike gives us a 31 delta. Sometimes people look to sell a 30-something delta or a high 20-something delta. Somebody that's more aggressive might even sell into the high 30s and maybe even into the 40s. Again, that's going to be a little bit more aggressive, but we're just going to sell this vertical. And we're looking here for a $1.40 credit. Now that's I'm going to say that is very healthy. Okay. So 140 is our max gain. And we're going to divide that by our max loss, which is 360. That's about a 38% return. So that's why I say it's in a healthy range that some people will feel comfortable with. Some people might not. If somebody's not comfortable with this 31 delta and they want to go further out of the money, they can. But your choices are really limited here because we don't have single strike increments. They're only in $5 increments, or when you drop down $2.50 increments. Okay. Again, we're going to do, in this case, let's just do 2 contracts. And we're going to do a first trigger sequential. And in this case, we're looking to buy back if we get a certain chunk of that max theoretical gain, right? So let's go $1.40 times, let's go again 70%. So we're going to multiply this by 0.3. And so we're going to say when it gets to around 42 cents, let's go buy it back. So we'll create that opposite order here. Go ahead, put it in. And I hope I made our other order good till canceled. If I didn't, I'll go back and look at that. If you caught me doing it, you could let me know. Where did we get the 230 from on the previous one? I'll go back. Let's go ahead. Let's put this one in. Again, we're going to put it in our options bucket. Option strategies. We're going to send this off. And we were filled on that right away. Let's see, on this one, we're still waiting to get filled on it. So the 230 here is essentially the net of buying the long call, selling the short call to kind of reduce that net debit. It's really helpful in stocks that are really expensive, but it's also helpful in stocks that have a lot of volatility priced into them, okay? So when we just said, hey, let's buy the vertical, that was the net of those two. Now, it looks like it's gone up here a little bit. We may have to give in a little bit here. Let's just replace the order here. Let's go in and change it to 235. So I want to make sure we get filled on this. I want to make sure that we can track it. All right, that looks better. We just got that sent. Eric said, I thought when you always start a call spread with the first out of the money call. So on AAOI, wouldn't that be 22.50? If somebody is selling, in this case, the 30, it's kind of at the money or at the money strike price, but it's a little bit out of the money in this case. And, you know, if you wanted to go out further, let's see what you were thinking here. You're thinking 32. Let's see, am I in the, I might be, that question might have come in earlier. You said, so at 32, shouldn't it be a 35.40? If somebody wanted to buy the long vertical and they wanted to go out and start out of the money, they could. In this case, I didn't. I just wanted to start with our at the money. If you buy the out of the money, it's going to be more aggressive. It's going to require a bigger move on the stock. Okay. Something at the money is something that is fairly common. In the money, somebody might consider that more conservative. Okay. Because if we had bought the 25 and sold the 30 and the stock's already above 30, that means both those options are in the money, means we'd have cost more for the trade with less to have a lower potential gain on it. Okay, so I hope that makes sense. All right, quick question for you. How many of you have not yet subscribed to our Trader Talks channel? I hope you will consider doing so. We have new people joining us all the time, so I want to make sure that they're familiar with what that means, why they might do it. You would click on this little, in your bottom right-hand screen, there's a little YouTube logo that's in blue. And and that allows you to subscribe. And when you subscribe, you can see our content so much easier. All right, I'm going to show you what it might look like. Okay, here's our Trader Talks page. And we can see here some recent classes. Oh, actually, these aren't recent, okay? This one from Barb was actually in July of this year, so quite a bit earlier. But you can see what's coming up. Like Mike Fairborn's going to be next on market and sector analysis. If you wanted to be notified of that class, you could go ahead and click on that and have it send you a little reminder to let you know. And then we've got different groupings of stocks. We've got some of our most popular webcasts. We have playlists for each of our classes, and then we have some other kind of special ones. A lot of people are starting to learn Thinkorswim, and so we've got a special one here about, how to get used to the platform, how do you use it, how can you do your most common things that you're going to want to do every day. A fabulous class for you to get on board with Thinkorswim. Okay, so that's why we really encourage you to do that. Well, we also encourage you, like I said earlier, follow us on X. And then if this is helpful for you today, go ahead and hit the thumbs up key. That'll let other people find it easier, I should say, our content, right? It helps us in the algorithm with YouTube. All right, so we've got our 2 trades on AAOI. Let's just check here. Let's do one more trade, and then I want to do a little follow-up. We're not going to do a ton of follow-ups here. But I wanted to get another trade in there for the idea of maybe trying to get that or discuss how do you reverse polarity. What do you do with a short vertical if it goes the opposite way than what you thought? Okay, so stock we're going to use here, GameStop. Now I know it's been a meme stock, but more recently it's got some more, I'm going to put it in quotes, normal trading activity, okay, versus the incredibly skyrocketing volumes like it had back here in the summer. Okay, it's just kind of settled down into more of a routine, and you can see it's been in a nice little uptrend. Now you're going to notice that it's right at kind of some short-term resistance. So in this case, it might be a trade that doesn't work out for us, even though it has a bullish setup. So I'm kind of secretly hoping that's the case so we can do a change of polarity, show you how that works, okay? So let's go ahead. Has actually some pretty decent volume here today. It was up higher. You can see how far it's pulled back. Earlier in the day when I was looking at it, Matt, looked like it was a really strong breakout. Now where it is right now, not so much, okay? But still bullish. We're going to go ahead and do a trade on it here. Now, this has weeklies on it, which gives you a lot more possibility of time frames that you might want to choose. We're going to stick with these December 20s. They're just in an ideal time frame, and we've got a lot of open interest here, and that really helps, okay, like we've talked about earlier. So on this one, we are going to look to do, we could maybe sell the 26, buy the 25 as our hedge, and doing a short put vertical. Oh, I wanted to show you, let me collapse this again. Look at that incredible implied volatility priced into the options. I think these guys have earnings in a couple weeks. Let's see how far out that is. Yeah, in a couple weeks they will have earnings, so implied volatility may even creep up, even maybe a little bit more as the stock goes into earnings. Okay, but lots of implied volatility priced in there. Now, what's interesting on this particular one is I started out looking at a 30 delta, okay? And so I was looking at maybe selling the 25, buying the 24. Well, that gave us a really healthy return. I was like, well, what if we go back a little further? Okay, so I'll just kind of show you the comparison, how I walked through it. So I'm just going to say sell vertical, and then we're going to go change this to the 24 strike. And that's looking like a 47-cent credit. So that would be our max gain, and our max loss would be what? 53. That's a really high percentage return on that. So I thought, well, what if we just back off a little bit, right? We know it's volatile. It's really juicy premiums. Let's maybe change our strike prices a little bit. And so we are going to settle on doing here. Let's just look if we did 24.23. See if it still looks like it might meet a lot of people's rules. Okay, 24. I shouldn't say a lot of people, some people's rules. Still a 40-cent credit at selling a 25 delta. Okay, that is really a healthy return. And it has about a 64% chance probability of expiring out of the money, which is what we want typically on short-term verticals. All right, we're using this for a couple of scenarios here. If somebody wanted to, the question is going to come up, well, could we sell the 23 and the 22? Yeah, we could. Let's go sell vertical. 23, 22. We're still getting a 33-cent credit, which is a pretty decent return. Let's lock it in. We're going to do this one. Okay. That is at a 20 delta. All right. 70% probability. But the reason we're getting such a high return there is because of that implied volatility being so high. We're going to do 5 contracts. And if we can get, again, let's go for 70% today. If we can get 70% of our 33 cents, then, oh, I did that in the wrong order. Sorry about that. Let's try one more time. 33 cents times, we're going to take the flip of that. We want to capture 70%. When 70% is left, there's only 30% left. Okay, so we're going to multiply this by, I think it's, I'm going to do it on my keyboard here. Times 0.3. Okay, should be like 9 cents here. Okay, so we'll do first trigger sequential. I think I missed a little decimal on that one. I'm going to create an opposite order. Okay, and we got a big chunk of that. We're going to buy it back. We'll just go at 9 cents here. Okay, we're going to make it good till canceled. Again, maybe this trade doesn't work out for us, and we can do a change of polarity. We'll see if that works. All right, let's go ahead. We're going to throw that in our option strategies bucket. All right, we got filled on it. So I told you we're going to do a little follow-up on a couple of trades. Last week we did some flags. And somebody said, you know, let's talk about the management of the flag trades. So I'm going to show you one that exited for us in a situation where we would want to exit, but obviously we'd want to make money on the trade. Okay, so we were trading Decker outdoors. Here was our long flagpole. It was consolidating here, and then it broke out. And it kind of faded a little bit by the time we got to the close. But it was, at the time we looked at it, was a decent breakout here. What did it do? It kind of just floated along. It didn't continue to move like we expected it to do. And the exit rule on a flag, if you're just playing the flag and you're not dealing with percentages or things of that nature, if it gets back down into the area of the flag, then we want to be out. And so we had put an exit there. Yesterday it came down and hit it, got us out of the trade, and it was probably a good thing. Right? Because it just wasn't taking off the way we expected it to. We had done on that trade, we had done a long call vertical. And so we ended up taking about a 29% loss on it. Okay. Next one up is the one to kind of discuss and go through here. Victoria's Secret, same thing here. We had a wise flag pole, flag consolidation. It was up a little bit higher. When we had our class, we were saying, hey, we're going to trade this. And pulled back. But the next day it went up. The next day it went clear up here to 37. So things are looking pretty good. It's out of the flagpole range. What's it doing right now? It's kind of settling back into this flagpole range. All right. It's not down all the way to the bottom. If I put my mouse right where the current price is, it's kind of like the upper quarter of the flag, although it came down a little bit further there. So we're going to have to watch this close. If it goes much lower, we're going to close down the trade. Okay. Typically on a flag pattern, we do want to see it execute fairly quickly. And let's see here. Where did she go? Right there. So we're only down about 15 bucks in it. We did a vertical. Oh no, we didn't. We did a long option. Take that back. Okay. We bought it for $5. It's $4.85 now. So we haven't suffered a tremendous loss on it. So we'll give it a little bit more time to go. But if we see time decay kicking in, if it starts going and basically getting down into the lower part of the flag pattern, we're going to have to exit the trade. Okay, if it goes sideways here for a little bit, we'll probably need to exit the trade as well, kind of minimize our losses. our expectation was that it was going to continue to go. So I hope that gives you a little bit more detail on those different traits. All right. So flag patterns, what's happening with these that we did last week, as well as a new synthetic that we're going to follow, as well as another one where we said we're going to do the long call vertical, short put vertical, see if we can get a change of polarity trait in there. Okay. And that kind of covers as much as we possibly can. Man, I'm out of time here today. You guys have been fabulous. You had some fantastic questions here as well. If I missed a question, I will copy it down and answer it. Somebody said, is there a link to the early morning mover scan somewhere? Bob, if you go out to a class I taught, I'm going to say it was 2 weeks ago. It might have been 3 weeks ago, but I think it was just 2 weeks ago in our getting started with, no, I think I taught it in long options. Okay. Tell you what, I will post a link to where you can see where I created it for you and the different variations I use of that particular scan. All right. Barb, thank you so much for helping out. Remember, we have up next market and sector analysis, kind of a real critical concept for you to be able to understand and be able to do that analysis. Mike Fairborn's going to be leading that discussion. So we'll be back up here top of the hour. Make sure to subscribe. Make sure you're following us. If you found this helpful, I didn't see a survey, but you could hit the thumbs up on the way out. Next week, I'll tackle some more of your questions. We'll see you then. Bye-bye.